Okay, so I'm here again. Thanks a lot again for having me here. I'll present another work which is not related to the one I presented last week. And this one, what I'm presenting, is work in progress. So I took the opportunity to have your feedback. And what I'm doing, this is joint work with a PhD student of mine, Andrea, and then we have two other co-authors that are based in Sydney. And we have a model of endogenous lending of money between banks, and we analyze also data that by now are just a support for the model. Okay, so this is a very brief sketch of what I'm doing. So the literatures on which I'm basing these tools are both very recent. One is about trading in networks. So you have some agents that have the possibility to trade it with each other, but there is a constraint on these trading opportunities. So you can assume that the network is exogenous. And then to have this network playing a role, you need some non-centralized, non-Warasian market mechanism. Essentially, out of equilibrium, on each link you will have a different price. And at equilibrium, as I will discuss soon, this price will converge. Okay, but along the path, the convergence to equilibrium, they have to be different. Another literature is about interbank networks and contagion, where in some cases the network can be endogenous. And essentially here banks make mutual agreements, and you have a trade-off between the fact that these mutual agreements can be insurances for small shocks, but they can also be a sort of contagion for large shocks. And then when the network is endogenous, the banks don't internalize the positive or negative externalities, so depending on good or bad times, the network will be over or underconnected. So we build a model of interbank network that has instead some of the flavor of the first set of models. So we don't model avalanches of contagion in the network, we just study a different source of contagion between the banks. And the intuition that will guide our result is based on that literature on trading network. So I just give you the intuition, then it will be different in our case, but just to have a hint. Okay, suppose that there is a network of possible trading relation between nodes. And suppose, for example, that this link is not present by now. Okay, then in equilibrium, think about the Edgeworth box model. On each link between two agents, you will have the same marginal rate of substitution between the goods. So it means that you will have the same prices on each link. Then, since for every connected component of the network, in equilibrium, you will have that this marginal rate of substitution will be the same for all the nodes in the component. So the prices are different on the path to equilibrium, out of equilibrium, but in equilibrium, there is a law of one price for each component. Okay, now suppose that you have these two components, each of them in equilibrium will be characterized by different prices. Suppose that you gave the possibility adding one link for two components to trade between these two agents, then generically they will have different marginal rate of substitutions between the goods, so they will have an incentive to trade. Yes?
So there are no intermediation costs, is that why the cost of the good is the same?
Yes, there are no intermediation costs.
Okay.
This is not my model, this is the intuition. So the main intuition is simply that because of trading, in equilibrium, all the nodes will have the same marginal rate of substitution between the goods. And if you allow for some endogeneity, generically, an equilibrium will make the network connected, because as soon as it is disconnected, different agents in different components will have an incentive to trade. Okay? So now the problem is, how can we discuss about marginal rate of substitution in an environment in which people lend each other money, in which there is a risk involved, and how can we then find an analogous to this sort of contagion? Okay, and what I'm going to show is that this sort of contagion will be implied with risk. So essentially, in equilibrium, the banks, because of trading, will end up having similar risks. Okay, to do this, and also to give you then the idea of what kind of model we are looking at, we will find motivation and support from a data set. So this data set is the Italian overnight market, which is called EMID, and it is based in Milan. We have data for almost 11 years, and along these 11 years, we have 350 different banks or trading institutions registered, of which 255 are Italian. Okay, but these 350 counts all the institutions that appears at least once in the data set. And for example, whenever there is a merge of two banks disappear and we have a new one from scratch. Okay?
Is this similar to Fed funds?
I don't know. I really don't know. But it's...
The Fed funds market has largely overnight, but also there are some term Fed funds lending between banks, and one of the institutional characteristics is it's lending for which the reserve requirement's been met.
Okay.
So you don't have to hold additional reserves because if my bank deposits funds in yours,
Yeah.
I've paid already the reserve requirements. You don't have to pay reserve requirements
Okay, I
on
see.
those deposits.
Yes, I think that is similar to this case. Okay, yeah. I should check.
But there are some non-bank participants, and then they don't get that advantage. But
Okay.
and they can only
Lending.
borrow. I mean.
Yeah, borrow. Sorry. Yeah. Okay, so the trading mechanism is decentralized, but the thing is that whenever a transaction is made, this becomes public. Okay, so all the other banks know about it, and a bank in principle can decide to make public the transaction, but not its identity, but it never happens. Okay, so everything is common knowledge is this environment. Okay, and there are different maturities, but more than 90% of the transaction are overnight or overnight long, which means simply that they are made in between holidays. Okay, so from Friday to Monday, for example. Okay, and even if for the participants not everything is clear, we have anonymized data, so we don't know the identity of the banks. Okay, and it's difficult. We have thinking about it to figure which banks are which nodes because there are not so few members. Okay, and overall we have data for almost 3,000 nights. So this is the more or less the structure of if each line of the data set, there is a date, a time, they trade during the day until 6 p.m. For loans for the next day. So in principle, there is a time effect, so interest rates are higher in the morning than in the afternoon, and there are also news going on during the days that change prices, okay? In the model, we will assume that it's one shot. So we assume a model in which at the end of the day, the banks decide to lend each other money, and then they have to wait the night and to see if maybe someone has not survived the night, okay? These are very small probability of default, but they take them into account.
So is it possible to do intraday overdrafts for free for these banks?
Sorry?
So in the Fed funds market, a long time ago I was curious, why are there overnight Fed funds but not intraday? And the reason was that actually banks at that time could borrow money for free intraday by just, they could have a deficit on FedWire during the day.
Okay. I don't know. I think they have access to a centralized market in this case to the European Central Bank.
But do they pay interest on intraday overdrafts You said the rates are higher in the morning than in the afternoon.
Yeah. So
Is that because of risk, or is that because there's an implicit interest rate between the morning and the afternoon?
in the model, I assume that it is because of risk. But you are right, it could be that it is some time delay. But we don't see. Yeah, we observe a decrease in rates along the day, but both explanations could hold for this.
So, yeah, the question is whether that's interest between the morning and afternoon,
Yeah,
or whether that's, or whether it's because,
I think it's a
way
matter of
risk is
accountability
involved.
because the big jump in the interest rate is around 1 p.m. I remember I learned. So this is where the accountability requirements change.
okay, so it's a reserve requirement.
Yeah. But what comes out is that there is not a law of one price. Okay, we have some tests, but essentially this rate varies a lot between the links. And the explanation is that they are not trading the same good, because when you lend money to someone, there is also the contingent idea that that guy may default, and then you don't get your money back. So if you are a bank that have a higher risk of defaulting, you will pay more for your money. Okay, and this will be implicit in the model.
Now, in the US market, I'm not sure the exact structure now, but I think it's similar. Used to be there was a structure where there's some big money center banks who are net borrowers, except for Bank of America, which has lots of deposits. And then there are like regional money center banks, and they're pretty much neither borrowers nor lenders net, but they were correspondent banks for little banks. And
Okay.
little banks cannot borrow in the market because they just don't have the credit. So they tend to manage their reserves by holding a surplus of reserves. And they were big net lenders in Fed funds. And the big banks are the net borrowers. And, you know, the big banks then will make loans to big companies and to other countries and
Yeah.
stuff with the money that's been swept up from these little banks.
Yeah, I think
if-
this
if
is
you-
the standard story for credit, for example, for industries, but I don't think it is the case for this data set. We observe a lot of variability. So the same bank that was a borrower the day before will be a lender the day after, and we observe a lot of intermediation. I show
And
you.
do pretty much all of the banks have access to borrowing,
Yes,
including the small ones?
yeah.
Okay.
So the structures that we observe vary a lot from day to day. We have codes for the bank, and what was surprising initially, at least for me, was first of all that these networks are mostly connected. So you may have some separated links, but they're very rare. I'll show you general numbers. And also the fact that you have a lot of intermediation. Okay, so for me intermediation was in some sense strange because if everything is endogenous, so for example, this guy, let me see a structure. This guy lends to this guy who then lends to this other guy, okay? So why should I go in between another institution if there is an intermediation? It means that it's profitable to make this passage. And then why should the two banks that are at the edges not trade directly with each other and pass through with intermediation? Okay, and this is why we start analyzing things with the model. Okay, and these are just 2 different days, but this is more or less the structure. And also the degree of nodes is much higher than 1. So we don't have people that tend to lend to several banks, and people that borrow tend to lend for different borrowers, so different lenders. Okay, so now I will go to the model, and I will use the data set just for partial confirmation that I'm on the right path. Okay, so it's a 1-period model, and everything is common knowledge. Okay, so we have this idea that there are a few players, and they know everything about each other.
So this is, okay, so, this is, usually when we think about financial intermediation, we think financial intermediation
It's because of symmetric information.
It's an information business, and so
Yeah,
the usual story would be the reason that I'm a dealer and you go through me instead of dealing directly with Hans is that I know what your demands are and I know what Hans' demands are.
Okay.
And that's information that you two don't possess. You don't know.
yes, this is the standard story of why banks exist.
And perhaps I know something about your creditworthiness, and that's something that Hans cannot assess directly. And
so,
so I'm willing to make the bet that Hans will be able to repay that you can't make because you don't have the right information. So
okay.
This is not what's going on.
No, this is not what's going on. Another interpretation for why there is intermediation is that there are small lenders who are risk averse, and then there is a big intermediator who is risk neutral. Okay, so accumulating all the money then can make lower interest rates.
So that's pure risk sharing, and it could go through intermediation or just could go in a big market.
Okay, but in this case, the agents are risk neutral, but they face risk in a different way because they themselves could have different shocks. So our story goes in the direction of the different risk attitudes. Okay? So the exogenous variables of this model are an initial stock, SI, for each bank, a cumulative distribution function of negative shocks for the banks. This support of the distribution could also go negative, so you could also have positive shocks. And then you have a cost of bankruptcy for each bank, or in a principal agent model, for the administrator of a bank in case of bankruptcy.
So they're not really risk neutral. Risk neutral says they don't care. They're indifferent between any random variable and its expected return.
Yeah. Okay.
So there may be risk neutral over.
No, but then when I compute, when I study the game, I will study expected payoffs. Okay, but this distribution function will be affected by the stock. I will come to it next slide.
Okay.
Okay.
Doesn't sound risk neutral to me.
Okay, and all these variables are not in the data that we have. But in the data we have the endogenous variables of their model. So banks lend money to each other. So this can be represented by a directed weighted network of quantities of money lent. And whenever they're lending some positive amount, they have an interest rate. For simplicity, I call this small r 1 plus the interest rate. Okay? And then you have also directed weighted network R, which has positive entries whenever this L network also has positive entries. Okay? Now, the capital of a bank during the night, so after trading has taken place, is given by the initial stock minus all the amount that the bank has lended plus all the amounts that the bank has borrowed. Okay? So the survival probability of that bank during the night is the probability that that bank is not hit by a shock that is greater by the capital during the night. Okay, so the survival probability of that bank can just be the cumulative probability distribution function over the overnight capital. And here is where I use this. Okay? Then one thing that will come out in the computation is just to say the hazard rate of this probability distribution for one specific capital. And this hazard rate is the probability that you are just at the edge of a shock, conditional on the fact that you are surviving. Okay? Or you can take it also as this limit. Okay? The shock is very near to you, but you survive. So just a digression about these hazard rates. Here are two plots of how they look like for a logistic distribution and for a normal distribution. And in general, they are decreasing in the capital of the bank. Okay? And we'll come to see that it has an interpretation of the demand and supply of money. And it was very hard to find, for us to find example where this thing is not monotonic. We found that for some beta distribution that are bimodal, it is possible to have non-monotonic hazard rates, but for most of the distribution that we can think about, they are actually monotonically decreasing. Okay, now we, before computing the payoffs, we make two assumptions, okay? The first one is based on my understanding of our understanding of how legal requirements goes in case of bankruptcy. And if you are a lender and you lended some money and the bank to which you lended money is defaulting along the night, you will not get your money back. But if you are a borrower and the bank that gave you money is defaulting along the night, you will have to give the money back anyway to some centralized institution that will repay external creditors. That is because in case of bankruptcy, the first money that are collected that goes in this interbank market for external creditors. We can relax it. We will see that it's not too important for our result, but from this we will get a straightforward result that is well confirmed by the data. So given this, we call the exposure of a bank what that bank is expected to gain or lose from this trading activity.
Okay, I don't understand this assumption. So if I can't honor all my claims, I give it to some bankruptcy court or something, some centralized thing.
Yeah.
Then how does the bankruptcy court decide how to pay off different people? Is it proportionate?
I think that in Italy or in Europe, the first
I'm
one
not
that...
talking about in practice, I'm talking about in your model.
Okay, they will collect the money and give the money to some player, to some agents that are not in the model.
Oh, okay, so if it goes bankrupt, they just throw it all
They
away.
pay small investors, which is in accordance with the law.
Goes to somebody outside.
Yeah.
Doesn't it go to the bank itself?
Sorry?
Doesn't it go to the bank that went bankrupt?
Well, in this case, it's gone.
Yeah, this bank is not there anymore.
Yeah, that's the unrealistic part, you know, where's the bailout?
Okay, but this
is
is
a model
a
without
big
bailout. But in any case, when it goes to repay external creditors, external means outside the model.
Yes.
So it's not that it's repaying some of it. So if the bank goes bankrupt just a little bit, it can't quite make its payments, then all of that is lost. You don't get anything.
Yeah, this is a simplified
You don't get
assumption.
anything. Okay.
Yeah.
Okay.
Okay, so in this case, if shocks are uncorrelated, and then I have a brief slide, next slide about what happens when there are correlation, then the payoff of one bank is just the exposure of the bank times the probability, the survival probability, minus, in case of bankruptcy, the cost of bankruptcy. And this, since you can take out this minus b, this is just the survival probability times the exposure and the cost of bankruptcy plus a constant. Okay, so when we analyze the game, we can take this constant away. Okay, what happens if shocks are instead correlated? Then when you compute this probability times the exposure, you should take into account the expected product of PI and PJ. Okay, and just applying the definition of covariance, you will have this added term here.
Okay, so
Yeah.
I'm curious, why, so we have this expected payoff, but shouldn't we be looking at whether kind of the realization of this number plus our shock puts us out of business or not, right?
Yes, but this is the expected payoff that you compute when trading. Then you stop trading, then the night has to pass.
What happens to the owner of the bank when you go bankrupt?
You pay minus B in the model.
Oh, so you get this whole payoff here,
Yeah.
and then you pay minus B.
No. You don't get any payoff.
Or you
You go bankrupt and you pay B.
You pay minus B instead. Oh, okay, so this is, so the PI, oh, okay, PI is this cumulative distribution.
Yeah.
Oh.
Okay, and just a note on what will happen if we put shocks is that you get a higher return if you lend money to someone that has shocks correlated to you. Okay, so we are not going to analyze this, we will come back to it only at the end, but this goes against diversification. Okay, because I is interested, when lending money to J, will get the money back, so he's interested only in the case where they both survive. So that bank would rather lend to someone who has correlated shocks. Okay, but from now on, we will assume that all the shocks are uncorrelated. Okay, so this is just an intuition of what will happen if they are not. Okay, then in this environment, we're going to characterize equilibrium. Okay, and if we had only to consider Nash equilibrium, then we will take only this first part of the definition. Okay, so no single bank can reduce by any amount the quantities that that bank is lending or borrowing, keeping price fixed. Okay, but for example, the empty network will be a Nash equilibrium in this case. And this is a standard problem in endogenous network formation model. So we allow from deviation of couple of banks. And we take a concept that is called bilateral equilibrium. It's come from a paper by Goyal and Vegaredondo in 2007 on a completely different setting. And it's different from the standard pairwise stability because we allow two agents to deviate from equilibrium by changing their own link and by changing also all the other links in which they are involved. Okay, while in pairwise stability, usually you say that a network is stable if no agent will erase one link and no two agents will add one link.
And who chooses our hat? And it seems like what rate I'm gonna give you is gonna depend on how big my exposure is, because
Yes. R
affect-
is endogenous, but in fact, no couple of banks would, in equilibrium, no couple of banks will change the interest rate between them. So if you have an interest rate on a link, that could be profitably be changed for both of these.
Okay, so when I'm,
So this line here just tell you that you are in an edge or box between the two banks.
okay,
But
so-
at the same time, they have also the possibility to reduce other links, other contracts that they have. And by playing with all these possible deviations, we are in equilibrium, they cannot be both better off.
so you can, so when you change it, we have banks,
Yeah.
and we're gonna renegotiate, but we're gonna take as given what deals we have with other banks.
Yes.
And we can make them a bad deal for the other bank, because I'm gonna be riskier
Yes,
now
yes,
than
sure,
the other
sure.
bank thinks.
But in equilibrium,
So the other bank isn't allowed to lend me money that says, the total amount you lend to anybody has to be less than this,
yeah.
or that you only borrow money from me.
But this is a limitation of most of the definition of equilibrium network formation model that are myopic. So when you change, you don't consider what will be the other changes.
So you're really restricting the debt covenants. Like a correspondent bank may talk to a little bank and say, look, you can only deal with me, or you can only borrow in total this amount from all the different banks you borrow from. You can't put any restrictions like that.
We don't have this restriction.
Okay.
And with this definition of bilateral equilibrium, we don't go much further. We don't study if there is uniqueness, if we don't even study the existence of this thing, but we characterize the topological properties. Okay, so part of the work in progress is to study the existence. Okay, yeah.
In your data for a given date, do you observe that Lij and Lji are non-zero at the same dates, or is always at least 1, 0?
I will come to it.
Okay.
Okay, so results from the model. Okay, first of all, like in edge or box, we find first order condition for being a borrower and for being a lender. Okay, when you are a borrower, by the assumption that you will repay the loan even if the lender goes bankrupt, you don't care of who you receive money from. Okay, so your interest rate will be, and this is simply the condition of first order condition, your hazard ratio at your endogenous capital in equilibrium times the gain that you will get if from the payoff. Okay, this was the exposures plus the bank specific cost. And we can call it RJ because it does not depend at all on I. Okay? And you can also find the same value as a marginal rate of substitution between money today and money tomorrow. Okay, so it's exactly the marginal rate of substitution between two goods. For a lender, things are different. Okay, because here, when you borrow money, you must take into account also the probability that the guy that is taking your money may default along the night. But when you take first order condition, you don't have only this element. You have also the fact that the more money you give to this bank, the more you will increase the probability of survival of that bank. Okay, so there is this extra term. Okay, now I'm not going deeply into this, but this term could be even more than one. Okay, so in some cases, if you are already exposed a lot to some bank, you may want either to lend money to the bank at a price which is less than the price at which you will borrow.
So you're assuming they're going to keep the money and not lend it to somebody else. That's part
In
of
equilibrium.
That's part of this way that I think it's a part of the definition of equilibrium. So when I think about changing how much money I lend to you, I'm going to assume that you'll just sit on that and that'll be additional.
But in
money
this is the CJ in equilibrium. So if J lends money out, the CJ goes down.
If you're borrowing money to me to lend to somebody else who's risky,
this will be common knowledge, and you will understand that I'm more risky by doing so.
but when I evaluate this at the margin, I don't take that into account.
Yes, I do, because I consider the CJ, which is the capital of the bank, considering how much that bank is borrowing and lending out.
But I thought when the two people negotiate, they assume that all the other lending and borrowing is fixed.
Yes, but then they endogenously set a price for that, which takes everything into account. So, just first result. So in principle, if suppose you have only the information that some of these things are positive while the other are zeros, you have 2L equations for 2L variables, where L is the number of links. And already by studying this equation, one found that you cannot have that bank I is borrowing to bank J, and at the same time bank J is borrowing to bank I. Okay, another things that the first order condition tell us is that the borrowing interest rate is constant for each bank. So you have, if you have in degree higher than 1, the price must be constant on that. By now we are not considering deviations to the network structure, but we can test these two things on the data already and then go on. Okay? The way we check that the hypothesis that the variance in degree price is lower than variance in out degree is by considering each single night. We have 2,750 of them, and make a one-side t-test on all the nodes that have in degree higher than 1, all the nodes that have out degree higher than 1, and assume that the variance of price on the first type of node is lower than the variance on the second type of nodes. Okay, and we obtain these numbers. So only in 27% of all the nights, we observe that these numbers may come from different distribution. Okay, but these t-tests are on small number, so to check whether this 27% is telling us something, we can do the opposite test on the other tail. Okay, and then we get a much smaller number. So the variance on the in degree is on this data somehow smaller than the variance on the out degree. So this confirms a bit the model. Another thing that we can check if there are loops. Okay, so the simplest loop is from bank A to B to B to A. So these are networks which approximately 400 links, more or less, on average, but the average number of loops per night along the years is very low. Okay, so this configuration we have very seldom. And remember, these are training that happens during all the day, so you could have adjustment that could make you give you these structures. Okay, then we will come to it from the theory part next. Also, the tree loops are very rare. Okay, and then higher order loops are even, I mean, you get just 0 all over the time. So let's see why you cannot have no loops from the model. We need to study a situation like this one. Okay, bank I lends to bank J, who lends to banks K. So you need to consider when this is possible and I does not have an incentive to deviate the money that I is directly lending to J to K instead. And remember, K will be indifferent because K does not care about where the money comes from. So if you just divert the same amount, K will not change her payoff. And the condition is that the expected return, so Pk is the probability of default of not defaulting, is lower for K than for J. Okay? This condition, which is a strict inequality, must hold even for longer paths. So it cannot hold for a loop. Okay? Because you could have that something is smaller, 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 up to the point that it's smaller than itself. Okay? So that excludes any possible loops in equilibrium. Okay? But, yeah?
So, I don't know how this relates to first order condition. It seems to me that if the two of us are bargaining, we're indifferent between my lending you £100 at an interest rate of 2% per year, or my lending you £200 and you lending me £100 at the same interest rate. Seems like we should be completely indifferent. So there's something in the first order condition that rules this out.
But the point is that
because,
we have,
is that because we just put the extra money at risk?
it will be indifferent if we have probability 0 of defaulting. But if this probability is even an epsilon,
it would be indifferent if they were netted out in bankruptcy.
yeah,
And they're not.
yes,
So we're exposing that extra £100
yeah,
in each direction to
some risk.
bankruptcy cost.
yeah.
That wouldn't be there if we didn't. Okay.
Okay, and by now we are not excluding anyway that I is anyway lending to K, so it's about directed loops that we are excluding. Okay? Then we need to consider what are the incentives for J. Okay? And if we analyze possible deviations of J, considering also the first order conditions, we see that J will accept to have this intermediary position if the amount of money that the bank J is lending from I is less than the amount of money that the bank is giving out to K, because otherwise that will be an incentive for J to reduce the amount lended to K and reduce by the same quantity also the amount that J takes from I, under the assumption that it was incentive compatible for I, this configuration. But you also want a condition on prices, so J has to gain on those prices, okay? And if you sum up the previous condition and this one, you get that the ratio of the price of these two loans must be in between this interval. Okay, so if it is too low, bank I would rather loan directly to K. If it is too high, bank J will not like to be an intermediary. Okay, just an intuition. Okay, what we can check of the data if actually when there is an intermediary, the amount that this intermediary takes from borrower is less than the amount that that bank lends out to, takes from lender is less than the amount that that bank gives out to borrowers. Okay, and what we do is to consider for each node that is an intermediary in each of the network, in each of the nights, the average quantity on the in degree is less than the average quantity on the out degree. Okay, and the results are not astonishing, but still we observe some drift in this direction. Okay, so it tends to be the fact that all the banks that are intermediary gets less money from lenders that they give out to borrowers. But it does not, they could have many more lenders than borrowers they give out. Okay, but this is to keep the conditions for those external lender not to, go around the intermediation, okay, and lend directly to the other borrower.
So is the intermediary protecting me from bankruptcy by the ultimate borrower? Seems like that's probably what's going on. So I'd lend to you at a smaller interest rate than I could lend directly.
Yeah, sure. Because
but the probability of default is smaller because even if the ultimate borrower defaults, you're the intermediary. You're not.
Yes, and in fact, the probability of survival of the intermediary plays a role. So if it's big, so I say if intermediary is good, okay, make its intermediation feasible.
So that's why I'm willing to pay you a higher interest rate.
Yeah.
Even though I'm paying you a higher interest rate than I would directly to
yes.
the ultimate.
It makes your investment safer.
Ultimate.
Yeah.
No, wait a minute, I got it backwards. So I'm lending you money, and even though I'm getting a lower interest rate than I would promise from the ultimate borrower, you're protecting me from the bankruptcy of the ultimate borrower, and that's
because there is some avalanche effect. The fact that I'm lending money to the other guy will increase my probability of default
a little bit,
but not as much as if you lend to that other guy.
It won't be as high as if I lend to the other guy.
Yeah, and it may depend either because I have a higher capital or because I face smaller shocks. Both cases are in the model. Okay, but now let's go to the point that I spoke about in the introduction about this sort of contagion that you can have in the banking. So all the results that we have up to now was just to see, relying on the data, whether the model is making sense or not. Okay? So consider a bilateral equilibrium and suppose that I and J are not linked. Okay? They could be directly connected but not directly linked. Okay, so by definition of equilibrium, there should not be a couple LR at which I will lend to J, or without loss of generality, the other way around. Okay? So what is the difference in payoff if they make this transaction? Okay, for the lender will reduce a bit his probability of surviving, but will gain from from the transaction. Okay, the receiver will increase the probability of surviving, but will lose a bit because we'll have to pay interest on the loan. Okay, and if at least one of these two is negative, we are in equilibrium. Okay, we can play with these two inequalities. Take the R that will result from first order condition that we had above, and we will get into these two inequalities. Again, if at least one of those inequality holds, then we are in equilibrium. Okay? So L must be less than this quantity, that is the same above and below, times this extra term that is there only for the lender, okay? Which is a term that is always greater than 1. Okay? So, since this, okay, so there will be an L that will make you not be in equilibrium if this thing here is greater than this thing here. Then you can find an L that fits in between. Okay? Okay, since this must hold also reverting I and j and for all L, you will need that these two things, this fraction here and this fraction here, as the same at the limit for L going to 0. Or put it in other words, you want this condition here to be satisfied. Okay? To see what this means, you can consider the Taylor expansion of this difference in probability, and a necessary condition for I and j not to be linked in equilibrium is that this fraction is the same for both banks. Is the derivative of a probability density function over the probability density function. Okay, which I don't know how to call. First thing to notice, this condition is always satisfied by uniform distribution. Okay, so any network will be in equilibrium if you have a uniform distribution of shocks. Okay, what about other distribution? How does this thing look like?
There should be a boundary condition, right, at the edge,
Yeah,
in addition to this.
that the edge is non-negative. Yeah, I said it's a necessary condition.
Oh, okay.
Okay. So, okay, first of all, let's see that what it means when you think of an endogenous network that you want to be in equilibrium. So, if this quantity is strictly monotone in CI, then this equality will be a non-generic condition. So you can say that, as in the example of trading that we had in the beginning, in a bilateral equilibrium, the resulting endogenous network will generically be connected. Okay? And if you look at the data, this is, for example, for year 2009, you have on the x-axis all the trading days. On the y-axis, you have this continuous dark line is the number of active nodes for each night. These vertical blue lines are the size of the giant component of the network. So all these networks are almost connected. Okay, like in the plots that I showed you, there are a few separated links out there. Okay, and if you look at the average node degree for each of these nights, it's actually important to notice that this average degree is below the threshold that you have in the Endogenous graph model for having connectedness almost surely. So there is something going on that makes this network connected. Okay, maybe you can have another random graph model which is not Endogenous that requires less connectivity, but still it is one result. Okay, and this is something we get from the theory that is respected from the data. Now and from here on, I will not rely on data, I will just continue speculating on the model. Suppose, for example, that the shocks are normally distributed. How does this ratio look like? Something that was surprising to me that I thought about is very clear. This is a very simple linear expression. Okay, so this is the probability normal distribution, and this is the derivative of it. So since it's just an exponential of something, you get just this simple result. So if shocks are normally distributed in our world, and two banks I and J are not trading a bilateral equilibrium, then they need to satisfy these conditions. But in particular, if they face the same distribution of shocks, they will have the same capital in equilibrium and the same survival probability across the night. Just because of trading, because if some bank is in a safer position than another, it will have an incentive to lend money to that other bank. But more generally, we played a bit with some distribution. We saw that this quantity is monotonically decreasing in most cases. So for example, for the logistic distribution, it has this shape. Okay? So, in general, if two banks, I and J, are not trading in a bilateral equilibrium, and they are facing the same shocks, and these shocks have a distribution that makes this quantity strictly monotone, then in equilibrium they will have the same capital and have the same probability of passing the night. Okay? And this holds independently on the bankruptcy cost, on the initial stock of the bank, and of the rest of the network in equilibrium. The idea is simply that otherwise they will trade. Okay? So, for example, and this is something we have to work on, examples that are tractable, consider a world with many small SI banks that face the same shock distribution, and a big safe bank B, whose probability is almost 1. Then, because of the argument we said before, it would be profitable for the small bank to go through the intermediary, but at the end, in equilibrium, all these nodes will either by losing capital or by receiving capital from the big bank, pose themselves in a situation in which they all have the same capital, so because of IID shocks, will all be in the same position of risk. Okay, just to conclude, we have a model that, and we still have to work on it, replicates well enough some empirical regularities from one data set, and shows that there can be an interbank contagion just because of trading. Simply the argument, because otherwise they will have an incentive to trade. Okay? And what we can do is that, as I told you, from the data we don't have all the variables that are exogenous in our model. Okay? So what we plan to do is we may get access to data from Australia and New Zealand. From what I understood, they are similar, but in this case we may have non-anonymous data. So we may try to check the prediction of the model more in depth by studying, for example, the exposures of these banks. Okay? And from a theoretical point of view, we need to work more on the characterization of equilibrium. So existence, uniqueness, and maybe it's possible to do so by reducing, the heterogeneity or playing with specific shock distribution. And one interesting thing is to include correlations, okay? But we have only a hint on that, but the intuition seems interesting on that. Because as we said before, when you have correlation, there is an incentive not to diversificate. Okay, okay, that's it.
I have a comment. I find it very interesting. Where I think you could maybe rephrase the question is you add, so in one of the slides you showed the capital of the bank SI, and then you add and subtract the interbank lending.
Yeah.
That seemed unintuitive to me because interbank lending is essentially a liquidity issue and capital is a solvency issue. So you're adding and subtracting liquid cash from the equity base of the bank, and your shock is the solvency shock. So maybe if you reformulated it, not saying capital, but actually liquid asset buffer of the bank, and then your shock is a liquidity shock.
Yeah, this is also in line with one of the story I heard about during one of the workshops in September, I guess, that the banks that defaulted during the crisis defaulted actually because they didn't have enough liquid stock. If they would have had time to liquidate all their existing stock, they would not have defaulted.
Yes, and if I'm
so SI could be the liquid stock.
if I'm giving a loan, if I'm a bank and I'm giving a loan to another bank, I'm not losing capital by
Yeah.
doing that. My capital is still
Yes,
the same.
yes.
My capital changes
But,
the moment the other one doesn't pay back.
Okay, then the
But
question
my
is,
liquid asset buffer changes
yeah.
because I'm giving out cash.
is it only an issue of terminology or will the model change? I mean, assuming that the results is short time horizon.
Yeah, your shock will be essentially a liquidity shock.
Okay, yeah.
So margin call. Right?
Yeah.
Well, overnight margin calls may be a bit tricky, but I think you can reformulate it such that it's the same. But it just seemed unintuitive to add.
Okay,
Yeah, why would my capital decrease if I make a loan?
but if I have written liquid capital, will it be? Oh,
Yeah, liquid assets.
yeah. Okay.
And then you have to we'll have to think what the shock would be overnight on the liquid assets.
Okay.
I mean, you can just say shock. You're not defining
Yeah.
solvency shock more precisely either, so
Yeah.
shock is fine.
Yes.
And do you actually have any information about the timing this transaction took place?
Yes, we do. We are not using it, so we only take all the transaction from the same day in the same pool, but we have the exact time of the day.
But when it was all connected, and actually in terms of lending and borrowing, is there any pattern on how this occurs time-wise?
I read other people that studied the same data set, and they were writing that in some of the early years, and this is also may explain why we have different data, since the interest rate was changing, some bank were, how was it, were lending in the morning and borrowing in the afternoon, gaining on debt. But this is, I don't remember if it was because of regulation or because of the fact that there were more risk. This is a practice that stopped. So in the first 99, 2000, you find some evidence of the data of this behavior, which vanishes.
And during the night, with the trading during the night?
No, all this transaction takes place between 9 a.m. and 6 p.m.
Okay, sorry.
And from 6 p.m. to 9 a.m. of the following trading day, they are frozen. So which is in line with our model. So you make the transaction and then you have to wait the realization of the shocks.
Okay, and in terms of the interlinks and outlinks from your notes, so how was this occurring?
So what do you?
Is there any part? So for instance, if we try to do it dynamically once these links between the banks were occurring, so
Okay. I don't know. I mean, dynamically on a single day, on a single
Yes,
trading
yeah.
day. I don't know. We need to check.
and another question in terms of lending. So when how do they actually work when they need to return the lending?
At what time do they give the money back? I'm not sure. I think it's at 9 a.m. the following day.
Or is there some difference in this between all these lending arrangements?
I don't know. I actually don't know. I think that all these overnight and overnight long, which is most of the transaction, are well codified things.
And did you also look at the amounts they're lending? So in terms of in and out?
There is one day each month which is different from all the others. We take them because at that day they have to meet the condition of the European Central Bank.
Yeah, no, I mean in terms of the linkages in your graph. So for instance, if you look at some highly connected guys in the
Yeah.
middle, would they have a lower amount than the guys on the edge or not?
A lower amount of
I mean a lower amount they're lending and borrowing or not?
I don't know. We did some analysis on how the price on a link depended on the network position of the lender on the receiver, and we got some results that if the lender is central and the receiver is marginal, the price tend to be above the mean of that day.
Okay.
But this could simply mean that the receiver is more risky in
Yeah.
the context of our model.
And in terms of sectors, in terms of actually exposure to the shocks, did you try kind of to make a difference in terms of kind of exposure to the uncorrelated exposure to the shocks and their position?
But we don't know the shocks.
You don't
When a node disappears, we don't know. Actually, I don't even know if there is any case of bankruptcy. But if a node disappears, it could be because of a merge or because of a bankruptcy. But yeah, we could look at the date. So we could see if some bank actually bankrupted during this period, which I don't know. No big one for sure. And on that day, we could look at the. But I mean, default is a very rare event,
Yes.
so we cannot measure it. We cannot measure this